Well, it's Rhonda Thomas again, and it's part two for personal finance static problems for chapter two. All right, so let me share my screen back to where we were. Okay, we were working on this annuity here, number four. So this annuity here, if you put $2,000 a year for 30 years, that's 7%. Calculator should be $2,000 is the annuity for 30 years in a row at 7%. Be sure to change your compounding to annually. Future value is 188,921.57. And if you look at table B, as in boy, okay, and that is a future value of an annuity, you would get 7% in 30 years. So 94.461. So that's very close to one another. Let's put the amount in from the calculator. I think that's going to be your safest bet, but it's still nice to understand how the tables work. All right, let's go to number 5. Now this one's a little bit different. We're going to look at benefit. Okay, I wish they would not have introduced this one to you because this is talking about federal income tax, which we haven't covered yet, which is more in chapter 4. Okay, but we're talking about career and salary and benefits and things like that. So let's put down what we have. This is going to be employee benefits. Some benefits are not taxable when it comes to your federal income tax. Let's go ahead and put down the federal income tax rate that this person is in right now, 28%. We have a non-taxable pension of 4,300 or the use of a company car with a taxable value of 6,325. Now, if you look at this amount compared to this amount, you would think that this would automatically be the better option. But this is like looking at apples to oranges. What we need to do is convert the non-taxable amount to a taxable amount. That would be the best thing to do. So we're going to leave the taxable company car alone of 6325. So whatever this non-taxable benefit is, here is the formula. The benefit value, which we have 4,300, divided by 1. 1 is part of the formula, minus the tax rate. 4,300 divided by 1 minus 0.28 is 0.72. So we're going to take 4,300 divided by 0.72, and you get taxable value. This is taxable value of that benefit. Okay, just trust me. This is the best way to do this. Once again, you turn non-taxable into taxable. Okay, so this is still more valuable, but this is a lot closer than it was at 4,300. Okay, now, so the first one is which one is more valuable? Okay, which one has greater value? It's still the company car on this one. Let's go to the second set of benefits. It's a life insurance policy with a taxable value of 450. So we're going to leave that taxable value alone, or a non-taxable increase in health insurance coverage valued at 340. So let's take the non-taxable and divide. We're still using that same federal income tax rate, 1 minus 0.28, which means we divide it, 340 divided by 0.72 means that this health insurance now has a taxable value of 472.22. That is more than the taxable life insurance policy. So that one was worth more when you figured out the taxable value. Okay? All right, so let's do a little more with some of this now. Okay. Asher is considering 2 jobs. We have job 1 and job 2. Okay, we have a salary for each job, and we're still using the same federal income tax rate of 28%. So here's job 1, here's job 2, here's the salary for job 1. Okay, so 36,500, and salary for job 2 is 34,700. They both have benefits that are non-taxable. So the first one is 4,500 for job 1, okay, and the other one is 6,120. Now, since these are both non-taxable, we've got to turn them into a taxable value. Taxable value. Okay, so this taxable value is right here. Okay, taxable value. So you take the 4,500 for job 1, divide it by 1 minus 0.28, which gives us 0.72. We're going to divide 4,500 by 0.72, and we get taxable value of 6,250. Then we're going to add the salary plus the taxable value of the benefit. Get the monetary value. So the monetary value is 42,750. Okay, let's do the same thing for job 2. So job 2 doesn't pay as good of a salary, but it has a higher value of a non-taxable benefit. So we're going to divide 6,120, which is non-taxable benefit of job 2. We're going to divide it by 1 minus 0.28, which becomes 0.72. So when you take 6,120 divided by 0.72, you get the taxable value of that benefit of 8,500. Now we want to add that to the salary. Now, which one is better? Okay, so let's go ahead and put the amount that we came up with. 43,200 is the monetary value of each job. And if you were basing your decision on monetary value alone, which position would have the higher monetary value? And it turns out that job 2 is, even though it has a lower salary, your benefit for your non-taxable benefit calculates to a higher taxable value. Okay. Number 7. So Olivia receives a travel allowance of $880 a week for her company for time away from home. If this allowance is taxable, she is using a 24% income tax rate. So that's different than the ones we've been doing. So I've got that written down here. Here's her travel allowance. We have to assume that she's traveling 52 weeks a year because it didn't tell us any different. So what amount will she have to pay in taxes for this employee benefit? So once again, she's traveling. She gets $180 a week allowance. If they didn't tell us how many weeks a year she works, so we have to assume 52. That's an extra $9,360. If she's paying 24% on any additional earnings, then she's going to owe 24% on that 9,000. So we're going to take that times 24.24 times the annual amount, and she's going to pay taxes $2,246.40. Now, if you take the total of her allowance for the year and subtract the taxes that she has to pay, then she's really only benefiting 7,113.60. They did not ask for that. They just wanted to know how much in taxes. She's going to owe a whole 24% on those extra earnings because she's already in the 24% tax bracket. Okay, let's go to the next one. I'm going to use the time value of money calculator. So Ava estimates that taking some classes would result in earning $5,200 a year more for the next 30 years. Based on an annual interest rate of 4%, calculate the future value of these classes. So if she socks away the $5,200 at 4% for 30 years, okay, this is a future value of an annuity, which is table B. We're going to look at 4% in 30 years. So let's go look at the table. Future value of 4% in 30 years is 56.086. There it is. Okay, we're going to take that times 5,200 and it calculates to be 291,642. Side note, if she just kept it in the sock drawer or the checking account with no time value of money, she would have only had 156,000. So let me put without time value of money. It's always good to think about that. So now let's go to the calculator. We want to put in the 5,200, which is the extra amount a year she's making for taking those classes. That's worth it. 4%, 30 years, future value. 291,641.68. That's how much I'm going to put in. I'm going to use the calculator, but I did check my answer with the table. Last one, it's similar to another one we've done. So Marla has a current job that pays 50,000. But she's offered a job in another city for 56,000. Okay, so here's her current salary, here's her job offer salary. The city she would move to has 8% higher living expenses than her current city. What minimum salary should Marla require before accepting the new position? So if the new city has an 8% cost of living, higher cost of living, we want to add 8% to the current salary. If she adds 8% to the current salary, the minimum she should take is 154,000. Okay. And if she wants to move to that new city and she wants to do that new job, then the answer is yes. Okay. If she doesn't like the city, if she's not sure about the job, then she maybe ought to reconsider, right? But at least it's paying her more than the 8% added to her current salary. So she wouldn't be losing any purchasing power or standard of living. Okay, that's it. That's it for chapter 2. I'm going to stop share. Thank you very much. Keep up the hard work. Stop recording.